Google just dropped one of the most jaw-dropping earnings reports in big tech history, and Wall Street is going absolutely wild. 6 firms raised their price targets overnight. The stock is up nearly 30% in a single month. So the real question is it too late to get in, or is this actually the perfect time to buy? Let's break it down. Welcome back. Today we're doing a full deep dive into Alphabet, the parent company of Google, ticker GOOGL. We'll cover the latest earnings, why analysts are so bullish, the massive innovations that are reshaping this company, and whether you should actually be putting your money in right now. Let's get into it. First, let's talk about what just happened. Alphabet just reported its Q1 2026 earnings, and the numbers are frankly insane. Revenue came in at $109.9 billion, beating Wall Street's forecast of $106.79 billion, and EPS hit $5.11, nearly double what analysts expected. This marks Alphabet's 11th consecutive quarter of double-digit revenue growth, 11 quarters in a row, people. Search revenue grew 19% year-over-year, with queries hitting an all-time high, meaning AI is actually driving more search, not killing it. And the crown jewel? Google Cloud crossed $20 billion in a single quarter, growing 63% year-over-year. That cloud number is what's making investors go crazy, and we'll talk about why in just a second. So why should you even consider investing in Google right now? Here are 3 big reasons. Reason number 1. It's actually cheap for what you're getting. Even after a 28% one-month rally, the trailing PE ratio sits around 15x, which looks very reasonable for a hyperscaler with accelerating cloud growth. For comparison, that's cheaper than most growth stocks trading at 40 or 50x earnings. Reason number 2. The AI story is real and monetizing now. CEO Sundar Pichai said, and I'm paraphrasing, that their AI investments and full-stack approach are now lighting up every single part of the business. This isn't just hype. Cloud backlog, meaning future contracted revenue, nearly doubled quarter over quarter to over $460 billion. That's money already locked in. Reason number 3, shareholder returns. Alphabet just declared a quarterly dividend of $0.22 per share, a 5% raise from last quarter, and they continue doing aggressive buybacks, so you're getting paid to wait while the business grows. Now here's where it gets really exciting, the growth engines that most people aren't paying enough attention to. Gemini AI, the core engine. Gemini Enterprise saw 40% quarter-over-quarter growth in paid monthly active users, and overall paid subscriptions across Google's ecosystem have now crossed 350 million, driven by YouTube and Google One. Google Cloud, the monster. Google Cloud's 36% operating margin is a massive signal. It tells you the AI capital spending is actually paying off in real profitability. Big retail names like Kingfisher, Target, and Wayfair all closed significant multi-year cloud and ads deals this quarter. Waymo, the wild card. Waymo, Google's self-driving car company, surpassed 500,000 fully autonomous rides per week this quarter. It also raised $16 billion in a new funding round, valuing the company alone at $126 billion. It's now expanding to Orlando, Dallas, Houston, and San Antonio, and a commercial Lyft partnership is coming later this year. The AI infrastructure bet? Alphabet is pouring up to $190 billion in capital expenditure in 2026 into AI infrastructure, servers, data centers, and compute. Pichai literally said their cloud revenue would have been even higher if they could build fast enough to meet demand. That's a supply problem, the best kind to have. Future perspective. So where does this stock go from here? At least 6 Wall Street firms raised their price targets on April 30th alone on April 30th. Susquehanna went to $460, Canaccord to $450, and TD Cowen to $450, calling the cloud numbers a monster AI inflection point. Needham also just raised their target to $450, and Piper Sandler says the stock still has a lot of room to run. Long-term, analysts are building their bull cases on Alphabet's growing AI role across both consumer and enterprise, its expanding compute capacity, and its position in key retail and tech partnerships. The key risk to watch, CapEx is elevated and expected to increase significantly into 2027, so if you're a short-term trader, keep that in mind. But if you're a long-term investor, that spending is building a moat competitors can't easily replicate. Google in 2026 is not the boring search company from 10 years ago. It's a full-stack AI powerhouse with cloud momentum, a self-driving car company worth over $100 billion, and a subscription business scaling fast. The fundamentals are strong, the valuation is reasonable, and the growth runway is long. That said, always do your own research. This is not financial advice. Every investment carries risk, and you should consider your own situation before making any decisions. If you found this breakdown helpful, hit that like button, subscribe for more stock analysis every week, and drop a comment. Are you buying Google or are you waiting? I'll see you in the next one.